Chat with Traders, episode 112.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
Sponsoring the podcast this week is the good guys at Gemini, the world's very first fully regulated and fully licensed Bitcoin exchange. Gemini is a venue for traders, investors, and institutions who want a much safer and more trustworthy place to buy, sell, and store Bitcoin. Gemini also support high-frequency algorithmic trading with an advanced API and provide US dollar rebates for liquidity providers. For more info about Gemini and Bitcoin trading, please visit gemini.com/traders and register for 1 month of trading with zero fees. Again, that link is gemini.com/traders. How are you doing, folks? Thanks for being plugged in. This episode is number 112, and my guest is Jorge Soltero, who currently resides in Puerto Rico. For a quick snapshot of Jorge, he began as a floor trader in Chicago, where he was an options market maker. A few years into his career, he landed a position at Hull Trading. This is the renowned firm of legendary trader Blair Hull. After Hull Trading was bought by Goldman Sachs in 1999, Jorge became more of an institutional trader, not only working at Goldman, but later UBS and Merrill Lynch too, where he specialized in options and ETFs. Listening to this episode, you're going to hear about the culture of trading pits, exactly what it was like to be a trader at Hull Trading, what makes ETFs an attractive product, amongst many other things too. It was fun to chat with Jorge. I hope you enjoy listening to our conversation. Here it is.
Good day today. I caught a bit of that rally in the U.S. equities. The dollar is actually didn't see where it was settling now, but I'm always fearful when Trump is talking these days. He seems to turn things. Whatever was happening before he started talking gets reversed. But no, today was actually all right.
Now you're living in Puerto Rico, correct?
Yeah.
Okay. And how long have you been living there for? I know you were originally born there and you've just moved back there recently. How long have you been back for?
Since August of last summer, so just coming on 6 months.
And what's it like there? I imagine it's a pretty laid-back sort of place, or is that just sort of how the movies portray it?
No, it is. It's not a full-on resort island by any means. There's a metropolitan area. There's 1.5 million people live in the city. So it's there's good bits of culture and, cinemas and auditorium and, concert halls and all that kind of stuff. It's a small city. And then it does have its laid-back island kind of beach vibe as well. But it's not all flip-flops and shorts. like you would think in the Virgin Islands or something like that. That's you have some commerce, but no, Puerto Rico it's a bit. I like to think it's the best of both. Great weather year round, fun people, fun things to do. Not quite the hustle and bustle of London by any stretch, but then it's always going to be over 25 degrees here.
Of course. And does Puerto Rico have a stock exchange there?
No, nothing like that at all. I always thought in terms of finance, Puerto Rico would be a great bridge between. So politically, Puerto Rico is part of the U.S., but not a state. But when it comes to finance, it's all U.S. regulatory stuff. The tax regime's a little different, but in terms of regulations, it's U.S. So I always thought Puerto Rico would be a great bridge between Latin America, say, and the U.S. for money coming in both directions. Never really caught on for some reason. There's a few public companies, a couple of big banks that trade on the stock exchange here. They all have reasonable businesses here for mostly retail finance and some investment stuff that goes on here, but not as an exchange or anything like that.
Yeah, I had no idea that Puerto Rico was part or owned by the US. Shows you how much I know.
It's a little far away for you for it to be on your radar.
Yeah, I guess so. So you moved to the US for study, going back to once you finished schooling and that sort of thing. You graduated from your studies with a degree in philosophy. How did a philosophy graduate get interested in trading?
Well, it's really because I was in Chicago. So in Chicago, you had the three major exchanges, as I knew the world at the time. This is coming on 25 years ago. The Board, the Merck, and the CBOE. So you were going to run into traders no matter what you were doing on any Friday or Saturday night. Some of my friends went into that bit of the business, and it always sounded pretty exciting and interesting to me. I'd seen it in Trading Places and Quicksilver, a couple of old movies. And all of a sudden I realized, wait a second, I got these three exchanges here in the city. You could go visitors gallery. You could interact with the guys. You just stumble and they're like, hey, how you doing? So I managed to meet a couple of them through one of my other jobs before this. And they said, yeah, just if you want to do this, just come on down and do it. Don't overthink it. Don't try to start doing it part-time and then maybe get into it. Just come down to the floor and, get a job. So I got a couple of interviews with market making firms, and they always give you puzzle questions to kind of test out your math. So it's not I'm guessing it's probably much more rigorous now than it was then. And so I made my way through the puzzle and the quick thinking math questions that they asked me. And so the philosophy degree was just kind of an amusing thing for the people that were interviewing me to talk about, because as far as they were concerned, it was a degree from the University of Chicago. They were happy with that. They figured anything I needed to learn about options trading and risk management and market making, all that stuff, they would teach me, or I'd pick up from the floor. I wouldn't have learned in school anyway. And so that's sort of how I ended up on the trading side.
Okay, so when you were going for these jobs as a trader, did you actually have a job already, like at the time?
Yeah, my first job was not in this business at all. I was working for the Archdiocese of Chicago at the time. So it was just, an administrative job. But one of our board members was a bond trader. And that was my first interaction with real pit trading and that sort of thing, as it happened in Chicago. So through him, I met some other people. And then I realized a couple of my friends had gone on to jobs in that area. So then I left that, and fortunately, it wasn't a walking away from a big salary to a trading kind of job with all the uncertainties that brought along. And I was younger, so it was a good time to make the transition, a good place to make the transition from.
And I'm just curious, you said that you had a few friends who were into trading. Going back, 25 years ago now. Are any of those friends still in the business?
A couple of them, I believe they are. The guy who introduced me to the firm I ended up joining, I actually don't know. I lost track of him. But a couple of the other ones still are. None of them are on the floor anymore. They've all gone on through to different things through the firms that they were with, and ended up upstairs. And some run their own firms now. Others are still just making a living, trading their own books, but doing it upstairs, and it's much more automated. Now, from my San Francisco days, which was a few years after that was an interesting breakup of the crowd, because it wasn't so much automation that broke up that floor. It was multiple listing. So San Francisco floor used to have basically a monopoly on a few technology stocks, including Microsoft and Cisco, Sun Micro. When multiple listing came around, and the SIBO and Philly and other places listed options on those stocks, a lot of the business drained away from the Picos. So those guys kind of had to figure out something else to do, and many left trading to do other things. Some in finance, some in real estate, all over the shop, really. But their edge from being good pit traders in the Picos, once that was gone, they knew they had to move on, and they're no longer doing that.
Yeah, that's an interesting subject, and I'm going to pick up on that in a little bit. Let me just ask you though, what was your first job that you got in trading? Who were you working for?
It was a small market making firm called Apollo Trading, turned into Apollo Derivatives later on. And that was one of the guys, maybe both actually, I don't remember exactly, was ex-CRT, Chicago Research and Trading. And I was a clerk in the currency pits at the Merck. So I worked for a couple of the currency traders. Deutschmark at the time was one of the main currencies that traded in the Merck floor. It was D-Mark, yen, and the British pound. And I alternated and clerked for traders in those pits for my first year there, maybe first 9 months before I actually started trading. Always on the options side of things. So these were options on the currency futures. Reasonably busy because you get a lot of hedging and offloading business from the big banks. So the futures pits were very busy. The D-Mark pit was huge. The yen was very busy, and I remember it was hovering around par for a while back in I think this was '94. So it just generated a lot of activity, and it really was the stereotypical, really noisy, very physical job. You see it actually in the Ferris Bueller movie. They have a shot of the Merck floor, and it's a currency floor that they're showing. And I was one of those guys in the yellow coats, giving signals and yelling out prices and looking after traders all the time, trying to learn the market making business from a floor trader's perspective. You using sheets, you're running P&Ls, you're running risk reports, you're following the order flow as it comes in from the floor brokers, giving orders out into the pit, people replying back with markets, everyone fighting to get a piece of trade. And just really trying to capture a bid offer, getting their hedges in, all done either by yelling or hand signals and stuff like that. It was controlled chaos. And after that, we moved. The firm wanted to go into the Eurodollar futures, which was an enormous pit. This was football field size, and the options were on one end, and then all the other different contracts traded across the room. And I guess there was thousands of people in here, and it really was a physical job there. You needed to be tall, you needed to be aggressive, because you needed to make yourself seen and heard across an enormous amount of people and enormous amount of noise. So we tried to break into that pit. That had mixed results. It was an interesting way to trade because it's not the most dynamic contract in the world. It tends to move and trend. But the option side were pretty busy, and there were some guys who were making a ton of money that were not super sophisticated in terms of the systems they were using or the option pricing systems they were using, but they were just really good at capturing the bid ask and spreading in and out of trades to lay off risk in what was a busy contract. So that's it was in that pit that somebody said, you never want to be the biggest trader in any one pit. You want to be at best maybe the second biggest. And I said, what do you mean? And he's like, well, you always want someone to get out. And that at the time didn't make a ton of sense. But as I developed as a trader, and as I saw other things go through in the business, you realize, yes, you need, who are you unloading your position with if you have to, or if you need to, or, something happens, you need liquidity. If you're the main liquidity provider in a pit, you can end up stuck. So it was one of those things where you, after years, you see the number one trader, the biggest trader in a pit, that position changed a lot. But the top five after that, they're usually the same guy.
I feel like I've heard someone else who was a floor trader on the podcast on a previous episode mention something similar. So it's really interesting that you say the same thing. When you say these pits were very, you had to be very aggressive and they were very physical. How physical did it get? I mean, were there times when fights actually broke out?
Yeah, there were. It was reasonably controlled, and these were people's livelihoods. So in general, although there were scuffles and shoving matches for sure, you wouldn't see a ton of activity like that on the actual floor because people would get fined or you'd get thrown out. And nobody wanted to, you pay a fine, and I hesitate to admit, but I got fined myself a couple of times, not for physical stuff, but for using non-business-like language on the floor. But no, people would actually walk off the floor and go to one of I forget what they called it when I was at the SIBO, but it was like, oh, I'm meeting you at the whatever. And you'd go, and sometimes they would actually fight. Sometimes it would get stopped before it started. It would get physical. When you think about it, I mean, you had all kinds of people with different backgrounds down there. It was everyone's livelihood that was at stake to some degree, different personalities. And you had, it's the job in a way I find unique because you spent all your day next to your competition, not your coworkers. So if you work for a trading group or trading firm, your other workmates would be in other pits. I mean, maybe there was a second trader in the same pit you were in, but by and large, you're spending your day with your competition. You're making markets against them. You're trying to get pieces of trades that they're doing the same thing. So it's a reasonably full-on competitive environment, and inevitably somebody would lose their temper, and it would get at least a shove of some sort, and somebody would cooler heads would prevail eventually, only because people are like, listen, you're going to get thrown out. Worst case, you could get arrested. Nobody wanted that. So, but yeah, people did leave the floor to go settle slights, real and perceived.
That's kind of funny. It seems almost like very schoolyard like.
There were some rules that were things that set off arguments. I mean, it's crazy things like your spot in the pit. It mattered. Where you stood relative to the order flow mattered. And there were some spots that were better than others, and some guys that were taller than others that, the taller you were in some of these crowds, the more real estate options you had because you were tall. If you weren't that tall, then you needed to be closer to this guy or closer to that other guy. And people would get in very early in the morning to kind of claim their spots. And as you establish yourself as a trader in the pit, whatever that meant for the particular crowd and the particular culture in that floor and on that crowd, you'd have less of a hassle kind of reclaiming your spot every morning. But in other places, in San Francisco, the market opened at 6:30 in the morning. I'd be on the floor at 4 with a bunch of other people. The floor didn't open till 4:30, but you'd have to get there to the vestibule, sit in the elevator bank, waiting for the floor to open. When the floor opened, everyone speed walked or raced to their pit to claim their spot. A couple of hours before trading even began, just because where you stood affected your ability to see business and to interact with the business that came into the floor. I think that's the prehistoric co-location is where you stood physically. Now it's just a matter of putting a server in a few feet away from wherever you need it. But back then you actually had to stand there. But claiming your bit of real estate set off a number of arguments, and those were ones I had as well. Some great insults were thrown at people at the time too, when things got heated about where you stood and where you wanted to stand.
I think that's a great description on how you describe it as like the old way of co-location. These days we have servers co-located and everyone's fighting for that. So yeah, that's a great way of putting it. So tell us about when you moved on to Hull Trading. How did you get a position at Hull Trading?
So I knew some of the Hull guys from, I traded in a 10-year pit. That was my first badge, was in the board, and I traded 10-year note options. And I knew some of the Hull guys from that, and also from the neighborhood in Chicago where I lived. And my wife actually worked for one of them that he was on a board. So I left Apollo, came back to Puerto Rico briefly, and Hull at the time had their firm and their market making business, but they were also backing a few traders. So I got in touch with the guys I knew, and they're like, "Yeah, definitely come in, see if there's a fit, and we'll back you." And I went in for my interview, and all was going well. But then I was the best part of a day at Hull talking to different people, but all of a sudden, more of the partners who were on the market making side, on the regular vanilla trading group side, started coming in, and they just turned around and said, "Listen, we can continue to talk about backing you as a trader, but we'd like to have you part of the regular trading team here if you want to consider that." And that's how that happened. Hull was at the time very well known. They were one of the bigger users of trading technology. At the previous firm, we used a third party, like many people did, use a third party options pricing system that you tweak. And we had some developers that kind of adjusted. I mean, they were somewhat malleable, and everyone was working on their own system as well. And so many places used a third party software, but Hull at the time, Timber Hill, and a place called G-Bar, they were known because they had their own systems. And the Hull traders actually had handheld computers. So they were a regular presence on the floor, the Hull guys. So they offered me a job to go work with them. I said, yeah, absolutely. That's great. I knew some of the guys already. I knew I'd get along with them. And so I thought it was a good fit, and it ended up being a very good fit for many years.
Okay. And earlier you brought up the point that when you went for a few of these interviews to try and get a job, you know, they asked you a lot of questions. There were some math questions and sort of some problem-solving questions. Do you recall any of the questions that you were asked in the initial interview at Hull Trading?
Yeah. So the Hull guys asked me. Let's see. There were ones that kept coming up. One of the guys said, "So you think you're okay with numbers, right?" And I said, "Yeah, I think I'm all right." And he said, "Really? What's 3/5 of 700?" So it's just arithmetic, but at the time you had to think quickly and get these things done in your head. So it was somewhat relevant. And then they asked about the Sears Tower, which I believe has a different name, but you could see the Sears Tower from the office we were in. So he said, "You see the Sears Tower there? Can you imagine a stack of pennies from the bottom all the way to the top of the Sears Tower?" And I said, "Yeah." Like, "Do you think that stack of pennies would fit in this room?" And so that was an interesting one. And it's one that we asked just to see how people think. And I know there's a different version of ping pong balls inside a Boeing 747, things like that you read about that even Google is asking now. And then there was another one about the NCAA tournament question was a classic Hall one, where they ask you, and I don't know if you're familiar with it, the college basketball ends their season with March Madness, which is a big 64-team tournament that takes place over a few weeks. And in fact, one of your other episodes, I think they were talking about the amount of betting that goes on around March Madness. Well, Hull participated in that. Everyone on the floor did. But there was a question that we asked. You find out where the candidate's hometown is, and it's like, okay, Joe, the NCAA has decided to host the entire tournament in your town. How many games do you have to schedule? And if you're familiar with the way the tournament brackets go and it's single elimination and all that, usually people would start thinking, okay, there's 64 teams, so the first round's 32 games. And then the next round is 16 and 32 plus 16. And as you see them going through that arithmetic in their head, you're like, come on, I don't have all day. And how long is this going to take you? And, you start getting them stressed. And, I think maybe one guy got it right out of the gate, but usually it was a good way to get them a little off kilter as they're trying to do all this arithmetic in their head. And then you tell them, okay, wait a second, let me ask you this. And again, you could only ask this question to people that knew how the tournament worked, which is mainly anyone in America, but not necessarily in London or Asia. Like, okay, you start out with 64 teams. How many teams win? You say 1. How many teams lose? 63. How many games do you have to schedule? I see. So it was one of those, trying to stress them out a little bit while they're thinking about numbers, just to be somewhat realistic. There were other things that other people did was actually get multiple candidates in one room and start asking questions and see who answered first and all that. We didn't do that.
Okay, well, you obviously passed the interview, so
Yeah, no. At that point, to be fair, at that point, I'd already been trading a little, a couple of years. So I was more of a lateral hire, although I did start out as a clerk for a few months, while they get comfortable and they figure out where they want to put me and all that. But yeah, definitely for the rookie guys, those were the kinds of questions that you got asked.
Sure. So when you first started there, you already mentioned that Hull was one of the few trading firms at the time that actually used their own systems. Was there anything else about Hull Trading that was obvious to you when you first started, that Hull Trading was not your regular trading firm?
Well, the way they took risk, and you notice, I stood in front of the Hull trader in the 10-year pit, who would become my coworker later on. But so you saw the way that they approached the trading side, and you had different kinds of traders. Some were more cowboys than others. Some were more aggressive and actually would lose their tempers or would want to jump on trades just to trade. They would trade out of boredom. The Hull guys I knew didn't do that for the most part. They were very systematic about following the way that they were pricing the options and the way that the order flow was coming through. So they wouldn't trade if they didn't have to. They wouldn't participate just to participate in general. And while they could trade as big as anybody else for sure in terms of capital, they wouldn't necessarily put themselves in a position to be sucking up all the liquidity just because they could. So they would participate along with the other traders. They would take the lead in busy markets just because they had better technology. So in terms of an interest rate move or a big number coming out and adjustments that you have to make to volatility or your forward curves, Hull would have those much quicker than anybody else. So they were more confident in their trading. And one of the things I was taught early on in terms of options trading was you have to trust your model. And that's much easier to say when you're a place like Hull and the model is your own and it's dynamically tweaked and you're more aware of how it works and who's behind it and how it's being implemented than if you're using a third party thing. So the Hull guys definitely had that mentality. Now we weren't, the expression was sheep monkeys. You still had a degree of latitude, and sometimes the computer wasn't faster than the way the floor was going, and you had to start, paying over sheets or under sheets while the systems caught up. But for the most part, they were very methodical about how they traded, and they were, although it was understood that they could be as big as anybody else, they weren't flaunting that. They didn't have any need to stand out in a trading crowd.
So with that being said, did the way that you trade change when you came into Hull Trading? Yes,
it had to. Well, the first thing was I went to a different pitch. So I went from having spent time in the 10-year note trading and then in the bond pit trading options, I went to equity. But mainly, you're trading now as part of a bigger group. And we had, I was in the OEX, the S&P 100, which was super busy. I doubt anyone even knows what that is anymore. But back then, it was supremely busy, much more so than the S&P 500. And we would communicate a lot with each other in terms of the levels we were seeing in our particular corners of the crowd. Just because the crowd was so big, things would trade, and we would make sure that we weren't getting crossed just because something's trading at the wrong price 100 feet away from you. So we communicated a lot. We trusted the system a lot. And that was also, it was a relief and an adjustment that all of a sudden you're looking at a machine and it can make you a little lazy in terms of, okay, if the price isn't the price I have showing me on my theoretical pricing screen, then I'm not going to trade it. You didn't want to do that, but your way of participating in trades changed, and the way that you went after some trades changed. So rather than wanting to be a small part of any ticket, you wanted to be a big part of good tickets and no part of some tickets. And you had more awareness of that because of the systems and because of the communication that was kind of triangulated across the traders and clerks that were working with us.
All right, let's take a quick breather here and give thanks to our sponsors. So support for this episode comes from the world's first fully regulated and fully licensed Bitcoin exchange, being Gemini. This simply means Gemini not only prioritized the security of customers' Bitcoin because it sounds good, but because it's an absolute requirement from their regulators. Gemini currently offers 3 currency trading pairs, supports 6 order types, and is open for trading 24/7, 365. Additionally, in an effort to make Bitcoin as mature as traditional markets, Gemini is the first Bitcoin exchange to offer daily Bitcoin auctions to facilitate large trades at an efficient price. Gemini also offer an API which is intuitive and will allow any beginner or seasoned trader to jump in feet first. To learn more about trading Bitcoin on Gemini, go to the link gemini.com/traders and register for 1 month of trading free of charge. Just to repeat the link, it's gemini.com/traders, spelled GEMINI. Also sponsoring this episode is Proper Cloth. To communicate to you exactly what Proper Cloth do, it's really easy. They make men's shirts that fit, and they fit because each shirt is custom made just for you. To order a shirt which Proper Cloth guarantee to be a perfect fit, or they will remake for free, here's how it works. Visit propercloth.com/traders, answer a few short questions, take your pick from over 500 fabrics, and check out using the coupon code TRADERS to save $20. And just in case you need another reason to choose Proper Cloth, please know they are the highest rated custom shirt maker on Google with over 400 5-star reviews. So, quit wearing shirts that don't fit and look the part. Visit propercloth.com/traders and use the coupon code TRADERS to save $20 on your first shirt today. So you're referring to models and systems here. How much discretion did you have to use compared to how much of it was really a matter of just sort of following the models and the systems that had been developed?
The way we wanted to trade, I mean, it was, I didn't always agree with this, but it was really a blackjack model, right? You're just trying to capture bid offer. You're not trying to put a position on. You're not trying to make necessarily a big bet on volatility, or certainly not delta. You're just trying to trade the bid ask and capture that all day long. The markets weren't always, so my big discussion with one of the financial engineers was talking about blackjack. Well, there's always another hand that gets dealt. And as long as you got capital, you can participate in that other hand. In trading, if the order flow starts going one way and all of a sudden you only have put buyers, well, you're going to be, as a market maker, you're going to be a put seller. And you can talk about bid offer all you want, but if no one's selling anything, then you're not going to have anything to buy. So every now and then you have to step outside and say, wait a second, which way have we been accumulating positions here? Maybe we need to alter what we're doing and be a little more aggressive than the system is telling us to be, just to come back to within our risk parameters, which were communicated across the floor with some regularity. So we know if our, and then this is something I don't think everyone did, but we were all aware of what our downside risks were and what our upside risk curves look like. So we're told, down 5, this is our P&L, down 10%, this is our P&L. And we had a certain amount of tolerance for things. And when you cross that, you have to start covering it. So then you would use your discretion to find the best trade to cover that without giving up too much edge. None, if you could, but if you have to give up some, then you have to try and minimize that. And that's when your skill as a trader and your ability to be, your pit awareness came through, because then you'd know where to go for that kind of risk covering trade rather than just the normal participating in the order flow that comes in.
Okay, so it was kind of a bit of both.
Yeah. And we were telling the guys, listen, ball's going up. You need to move the market higher. The skew's moving this way. I mean, we would see that in the pit before the machines would pick it up. So you had to have that kind of pit awareness of what was happening, what was going on with the order flow, what was going on with the market, and relay that to the machine. Now it's changed because all the order flow goes through electronically, so the machine can interact with it as it's going through. I'm using machine generically for any model or anything that you're using to price options. But the better you were at communicating what you were seeing in the crowd, the more likely you were to have accurate and fast systems to deal with it.
Now, for someone who worked at Hull Trading like you did, how obvious or how prevalent was the blackjack influence?
You were very aware of it. When you joined, you were given certainly when I joined, a copy of the New Market Wizards interview with Blair. So you were aware of whose name you were standing behind. And there was a fair amount of card playing on the off trading hours time, and a lot of chess playing by the developers and the financial engineers. But the whole blackjack thing, the whole have an edge, exploit it when you do, scale back when you don't. That was always talked about, and it was talked about in different ways in terms of what our overall firm risk was, what the different instrument risks were. So if you're trading in the equity index crowd, or if you're in the financial, in the fixed income crowd, all those crowds had their own different risk metrics. But it was always in terms of the whole, this is what we think our edge is. If you see something that's outside of this, then we want to bet big on it. And we were all aware of how Blair had made a lot of money. We were all aware of the Beat the Dealer book. When we went to the riverboat casinos, we were always mindful that we played good strategy in blackjack, just because we didn't want to come back to the office and say, I had no idea what the count was, and I lost money. That'd be a little embarrassing. So it was reasonably prevalent.
Yeah, when you first started your answer there and you said that you were given a book, I thought you were going to say you were given a copy of Edward Thorp's Beat the Dealer.
No, you know what? I remember looking for one after reading the interview and not being able to find one. I don't know if it'd been out of print. It was a book I was looking for, and now I got to pick up his latest one, which looks pretty interesting.
Yeah, no doubt. I've started reading. I've got the Kindle version of it. I got it sort of pre-release because I did the interview with Edward Thorpe. So if anyone listening wants to check out that interview, it's episode 109 with Edward Thorpe. But I do need to pick up a hard copy. For me, hard copy is the way to go. I know, call me old school.
Yeah, that is old school. No, but it's the whole modeling thing. I remember I was just thinking now in terms of gambling. The NCAA tournament was a big recreational gambling thing that the guys did, along with what was called then rotisserie baseball, fantasy league baseball, which was done by hand or on Excel spreadsheets from data that you'd get from the newspapers. I mean, right now it's much easier to do all online, but at the time it was all very manual intensive. And I remember going to the off-track betting site with some of the guys from Hull, and one of them had a handheld, probably wouldn't be nearly as powerful as an old Nokia, but it was what people had at the time in terms of handheld computers. And he had designed a quick and dirty model to see horse betting. So it was a bit of a disease with the guys that trading there to make a model, try and model everything. That no matter what it was that you were doing, you're trying to pick it apart and design a model around it.
Did he have much success with it? Do you know?
It was meant to work, but the problem is the off-track betting place didn't cooperate. So what you needed to see was it really tried to capture the changes in the odds in the time leading up to a race, and then you'd place your bet right before from what I understood him telling us this. I mean, I thought it was the nerdiest thing on the planet to try and be typing into a microscopic Excel sheet on a handheld computer when you're out in the track on a Friday afternoon. But I think it was meant to work, but the odds flashed on the screen. They didn't stay up long enough for you to capture it, so you could write them down, or for him to put them in his little handheld. So that was a big flaw in it.
I'd look like a total nerd too if it made money, if it worked,
If it worked, no, we couldn't knock it too much. We just thought it was a lot of work, because every time the screen rolled through to the race he was looking at, he's like, everybody, wait, what was that? What was that? And inevitably you wouldn't catch all of them and it wouldn't work, but sometimes it did. And then it seemed to have some science behind it in terms of just capturing the velocity of money.
So in 1999, Hull Trading was bought by Goldman Sachs. Just to recap on your experience there, what were some of the biggest things which you took away from having worked at Hull Trading?
The whole team aspect of it was very important. And when you got interviewed, fit was a big deal because they needed to know not only you were a good trader, but that you were a good trader in the way that Hull does things. And it wasn't also just about interacting with traders. You interacted with the financial engineers and the developers quite a bit. I mean, we were all in the office together. We all sat down for morning meetings. Everyone heard the P&L and risk calls together. So you did get a very strong sense of camaraderie and a sense of this is what we're up to, and this is why, and everyone has their own particular jobs. And it was a very good lesson in how to do things that are complicated and splitting jobs apart and getting the best people to do the tasks they're best suited for in order to get the best results you can. Now, it wasn't perfect, and there were situations where, models break down and things just go awry, but because you've done it as a team, you react to that kind of setback better as well. Because there's a sense of, we went in together and we thought we had a good plan. It didn't work. There was never any severe pointing fingers or the what do you call them? The postmortems on good and bad things were always very healthy. And that, I think, was a meaningful thing. And some of it carried over to Goldman Sachs, having come off being a partnership, the whole fit and teamwork aspect of it, a much more competitive place to be sure, but there still was a culture of fit and understanding. There was a culture, and you have to understand it and be committed to being a part of that.
Yeah, and that's one of the things that really stood out to me when I interviewed Blair on episode 85 is that his comments around the team aspect. I thought that was very cool to hear about.
It was a big deal to him, and he did walk around the floor. He knew, not around the office, and he knew everybody that was there working for him, and he was a good resource to have around. But he was a visible presence on the floor.
Mm. So after the buyout in '99, what were you doing at Goldman?
So the guys that I was working with at the time, I was running I was the senior trader in San Francisco office, which was 3 people. And trading Microsoft and the Qs had just been listed over there. The opportunity came for me to move to London with Goldman. So a year after the buyout, I packed up my stuff and we moved over to London. So, everyone's pretty excited to have Goldman Sachs buy us. I mean, we understood the mystique of the firm and the lore. But at the same time, we were a bit nostalgic because we were a small firm. We all knew each other. We were like, now we're part of something that's enormous, and how's that going to work? I was actually pretty excited. I knew the reputation Goldman had, and I thought I'd really just got into Goldman through the back door, and I'm sure some people there would absolutely agree. But I was pretty excited, and they offer to move me over to London and trade over there. No idea what I was walking into. But I was pretty excited.
So tell us a little bit about how you managed the transition from going from a floor trader to now trading behind a screen.
That was hard, and it was an ongoing project for a while, because the first thing, I talked about how physical and competitive the job was. Well, that's a hard thing to turn off as a trader, that you're now sitting alongside your coworkers. And you're interacting with a screen, and at the time, phones. Now it's even less of that, but at the time it was mainly pointing and clicking, and then picking up a phone and talking to somebody. That was a big change because you're used to the energy, the noise of the crowd, and you feed off of that. You kind of get a sense of the rhythm of the market by what's going on in the noise level. So if something, and just across the floor, so not just your pit, but other things too. So the bond, big order comes into the bond pit, you pit in 10 years, you're going to pick that up from noise before you even know what's going on. So you lose things like that instantly. And I was a bit lost. The guys when I moved to London, I was one of a couple of guys that came from the US side. Most of the Hull guys in London and Hull Goldman that joined Goldman were coming from the Frankfurt office. So they'd been trading off floor for a few years already. So they knew. For me, it was hard. The quietness of it, the relative silence was hard. I mean, it was a noisy trading floor, and there were people talking about stocks and screaming and yelling some things, but it was nowhere near the level of energy that you get from a trading floor. And you also have to calm down a lot. You can't be as excitable. The orders aren't coming as fast and furious as when you're in a trading crowd. So you're interacting with things that come via chat message or even email, maybe a phone call. You have a lot more time to think about what you want to do and how you want to price something, because the rest of the stuff is actually just being done live on a screen, and you're not necessarily interacting with it that much. That was very strange. It led to me being told to please calm down and not be as aggressive on the floor with salespeople, things like that. I mean, again, I hate to admit it, but it was one of those things where, you have to be told, listen, you're not on the trading floor anymore. Calm down. And you take that to heart, and you're wearing trousers, slacks and a shirt now rather than khakis and sneakers and a tattered tie around your neck. You're like, okay, I guess I need to shape up here.
Yeah, and did you personally know many traders who actually did really struggle and actually failed to make that transition successfully?
I did, because as I was leaving the P Coast, it just happened to a lot of the guys that were in the Microsoft crowd with me. So again, their main edge, they were sharp guys, they were risk takers, they were good with the numbers, and they were good Microsoft option pit traders. Once that went away because the order flow dried up and it was going to the CBOE in Chicago, all of a sudden they're like, wait, there's not as much order flow for me to interact with. There's not as many people in the crowd for me to trade off of. Maybe I'll go upstairs. And it just didn't work. Some of them didn't really fit the mold for an institutional trader. I'm not saying I did. I just, again, we got into the back door to the institutional side because of the Goldman buyout. I ended up having a reasonable upstairs career, but not everyone did. And the guys that went off on their own from a floor, that was their edge. And once that was gone, they had to find something else to do.
Was there a particular line of work that most of them actually went into? Like, did they find other jobs, maybe not as a trader, but still something related to financial markets?
Yeah, in finance, I would say from memory, a couple went into retail brokerage, and one of them actually was pretty successful because he had options knowledge that gave him a bit of a sales edge when it came to talking to clients about, advising clients. Not every retail broker is a former options trader that can talk reasonably about the opportunities for a retail account in trading options, such as they are. So that gave him a little bit of an edge in a new kind of venue. Other guys went into a lot of guys went into real estate, and again, this is San Francisco in the late 90s. So we didn't realize the market was going to crash, but a lot of them went into real estate and did that or mortgages for a while. The funny thing is, once you're not on the floor with them anymore, you have very little in common with them. You don't interact with them as much. And back in when I left and moved to, I didn't just leave and go upstairs. I left and went to another country. So without Facebook and LinkedIn and Twitter and everything else, it was a little harder to stay in touch. So you do lose track of them. Not all great stories. Some of them did fine and reinvented themselves. We were by and large pretty young people in our early 30s, kind of on the high end. So it was it was a forced change for some of them.
Okay. So you worked at Goldman Sachs for a few years after the buyout, and then you also went on to UBS for a couple years, and then I think you did about 10 years at Merrill Lynch. Do you just want to give us a quick overview of the sort of things you were doing at those companies?
Yeah, so Goldman and UBS was all index option trading. In Goldman, it was in Europe. So the IBEX mainly. I didn't do that much Euro stocks, which was the dominant contract. Once the DAX kind of fell apart, it yielded to the Euro stocks. And I traded mainly FTSE, SMI, and IBEX options while I was at Goldman. It was an interesting time, but different way of trading than what I'd done at Hull. Now you're making prices for clients, and you're making prices to kind of take a position. You have to have a view, and you hope that you get a way to unwind it with other client flow or other market flow. But you have to be comfortable with the position. So the position sizes were much lumpier, and risk management was different at that point. And that's one of the strengths of the Hull system, was to be able to decompose your risk management. And that's one of the reasons Goldman bought Hull. So it was basically using the systems I was familiar with, but doing new things with them. UBS was back in the US, and I traded S&P options and the SPY options that came online while I was there. That was a new product that came out. But then when I moved to Merrill, I switched, and I went more into my initial role there was a hybrid derivatives and equity finance role. So what ends up happening is banks have a lot of stock inventory that can be used in a variety of different ways, and through the derivatives desk, I should say, end up with long and short positions that can be optimized. And because I had some experience with equity finance at the time, I kind of ended up in a newish role that Merrill put together, which was a hybrid equity finance derivatives role. And I did that for a couple of years, including some corporate action trading, which again had a equity finance kind of bent to it. But then just after the crisis hit in 2008, in early 2009, Merrill offered to move me back to London to run the Delta One desk over there. And that's what I've been doing up until now, when I just left. So that was ETFs, index swaps, and stock index futures.
Okay, and as someone who was running a trading desk, what sort of things did that involve?
Well, then it becomes, your main thing is, are you interacting with clients are you prepared to interact with the clients in the correct way? Because that's where your order flow and your positions come from. So you've been trading for a while, you understand the trading and risk management side, you have your market views, you understand how you're going to make prices in the instruments that you're trading. So, but now you have to worry not just about managing a handful of traders, but also making sure that you're interacting with clients in the correct way. So, because that's where your money comes from, orders from them, commissions from them. And that involves giving them ideas. It involves working with the salespeople so they know what you have in your book and what they can help you in or out of. It involves, dealing with the different personalities on the desk and understanding how they want to trade and how you need them to trade, and see who is going to be better at this kind of pricing and who's going to be better at this other kind of pricing. Just allocation of resources. It's a little different than just running your own options book. Now it's a mini business within the investment bank.
So, let's sort of move on from this a little bit. But before we do, it's safe to say that the majority of your trading career this far has been really in the professional, institutional side of things. Is there anything that you think retail traders could adapt from how you've traded over the years?
Let me think about this, because the main thing I would say is that the information edge that an institutional trader has is no longer as wide a gulf over the retail trader or the retail investor as it used to be. And I'm not just talking about CNBC, but there are so many resources that are available at zero or manageable cost to folks on the street or they're not in these institutions, that I think that's a big thing. You talk about a lot of the regulations that have come through and a lot of the market structure, how the market structure has changed. It really has benefited the end investor in many ways because of deeper liquidity, tighter bid-offer spreads, more access to markets, and that can be good and bad because it can lead to overtrading or people getting involved in instruments that might not be suitable for them. I had you see things in some commercials that you're like, wait a second, this isn't suitable for these people. How are they making this available to anybody on the street? And you need to have a little bit of market understanding before you start trading some of these things. But by and large, the edge that an institutional trader would have had over somebody on Main Street has diminished. It's not gone by any stretch. Obviously, you have much more visibility to everything that's going on. But because things are more electronic, because a lot of things get reported real time, because there's access to a variety of different resources for information, not just the news channels, but just online and the wires, I think that they can really go in thinking, okay, I'm not as at a big disadvantage. Because the other thing that's happening is it's all gotten much more competitive and heavily regulated on the institutional side. So, it's really no longer the case that one bank has one client that's a market moving client wrapped around their finger, and they're the ones that are seeing how this works out. Most clients can't do that. They have a duty to find the best price for the structure and shop things around. So things get around the street quicker, and it's not, and it leads to more competition on the pricing side, and it leads to better execution for everybody, but also just things get communicated quicker. So I would say don't underestimate the fact that the playing field is not as distorted as it certainly used to be.
Yeah, okay. I think that's a fair comment. So as you've now moved back to Puerto Rico and you're essentially no longer an institutional trader, you're just trading your own money, you're essentially trading a retail account. How has someone like yourself, with that experience, approached this? Like, how are you now approaching things as essentially a retail trader?
Sure. The first thing is the position size matters. And I've had to manage risk in a variety of different guises. So I'm comfortable with risk. I'm comfortable taking risk. The position size now, I have to think about it a little bit. It's not more, it's no longer a case of, am I comfortable being long, X many millions or short this, or now it's more like percentage of the capital that you're using, and you have to be more tactical, and you have to, you like a position, how much capital are you going to allocate to that? That was never a consideration I had as an institutional trader, or even as a market maker, just because the pockets were that deep, and I was very fortunate in that regard that things were managed, that kind of thing was managed away from me. So the first thing is really think about position size and think about how you're going to use, how I'm going to use leverage, which is another edge that we have, is there's readily available leverage. If used judiciously, that's really the way that, you can maximize your edge as a person sitting behind a desk trading this, that, and the other thing, and testing a variety of things out. Getting used to being by myself, that reminds me back to the pit trading days. So although I spent most of my career on the institutional side, the pit days are the ones that I enjoyed the most. That's where most of my fond memories are, just from the way trading happened. So that's taken me a little bit back to those days where you're a little bit isolated, and you think about what you want to do and how you're going to get it done. So that's how I'm approaching the business that I'm doing right now. What do I want to trade? How can I trade it? How big? How small? What's the right way? And then what information is out there, and what systems, or how am I going to apply the systems I have? What else can I get? I mean, right now there's also the exploration phase of what's out there, and there's a lot of noise, but there's enough out there that's good that you can extract value from in a different way than what I'm used to. So it's been really a throwback to my floor days, where kind of on your own, even though this time it's my own capital at risk.
And also presume that the actual sort of trades that you're taking are quite different as well. Like your actual strategy is vastly different from how you would have been doing it over the past, 20 or so years. Can you talk to us a bit about how you've approached that side of it too? Certainly. And this is one of the things that on the institutional side, you're reacting to cry and order flow. You can, our ability to put positions on, and you always hear institutional traders say, I'm a great trader and I have this on and I have that on.
But because of regulatory pressures, a lot of that went away. You simply couldn't be a prop trader sitting on a sell side seat because the regulations wouldn't allow it. So you had to react to client order flow, and your edge was where you sat, the fact that you would see many different orders, and you had to formulate a market view before you priced anything for a client. That's gone. Now I get to do whatever I want to do. So the whole idea generation bit, which we used to do for other people, now I get to do for myself, and I can put them in context of something that I want to do, that I'm thinking about. A lot of ideas that maybe, we had on our desk wouldn't be interesting to clients that we were talking to because, they are pharma traders and all they care about is what the next pharmaceutical stock that's going to gap up 15% is. They don't want to hear that you think the high of the day is a buy because it's going to continue tomorrow on the main index, because they don't want to trade indices and things like that. So while as a trader you want to trade a liquid thing that's going to give you a chance to do things around it, when you're in an institutional desk, you're just reacting to order flow. So thinking about what I wanted to trade, that took a bit of time, where the liquidity was and where I thought I could put some things together to extract value. And it's been a mixed bag of success so far in the last really 6 months of just under 6 months of actually doing it. But I'm reasonably optimistic we'll be able to do something cool.
And so you've also been experimenting a little bit with models as well.
Yeah, nothing super sexy, because at the end of the day, I wasn't a financial engineer. So that involves seeing what I've been able to buy or get, and now thinking about programming languages and how quickly I can teach myself to do some rudimentary stuff, possibly hire somebody and work with them, which I know in some of your other episodes, guys have said they've had to do that. And I think that's going to end up being a part of what we do, simply because there is a lot of data out there. There is value in that data. There are ways to look at it to try and make money trading. Clearly, people do it. I think I've come across a couple of different ideas that I want to try out. So that involves modeling them out and working with global data providers and different number crunching apps to try and see test things out.
Absolutely, yeah. Just moving on to this, just a completely different subject. ETFs, trading ETFs. This is something you mentioned that you might like to speak about when we were initially talking prior to this. And trading ETFs is obviously something you've done very much on the institutional side. Why have ETFs been an attractive product for you to trade?
I came across ETFs in '96. That was, I think, a couple of years after Spiders first came out. And at the time, I thought, this is great. It's a way for me to trade the whole index without having to trade futures, which I wasn't qualified to trade. I mean, you have to open a futures account. I didn't. That seemed complicated, even though I was already in a trading job. It was just a very efficient packaging of things that I wanted to trade. And that's how I first came across it. As time's gone on, I just really appreciate the variety of products that there are now in terms of thematically, you can find a passive instrument that's easy to trade, cheap, and easy to execute, because you can get in, you can get out. The pricing is, for the most part, pretty reasonable. In terms of the bid ask, they're liquid. They're taking over the liquidity profile of the U.S. exchanges, really. So it's just been a good way to express views long term or more dynamically, because of the trading aspect of it, and the fact that there's just cheap ways to express these views just made it a very, very interesting product to me.
So for traders who are new to trading ETFs, is there anything important which they should perhaps be aware of?
Yeah, I think if you need to think about how you're going to use the product, and if it's going to be a long-term strategic hold and investment, then you can take your time, find the cheap, because they're inevitably, unless you're doing something that's really, really unique, like even Blair Hull's own ETF product. That's it. That's the only one of its kind. But if you're talking about a sector ETF of some sort or a broad index ETF, there's going to be more than one flavor of them. You can take your time, find the cheapest management fee, and buy that and hold it. If you're going to be trading, then you can worry less about what the management fee is and find the most liquid one. But it's worth looking into, and a lot of this information is out there on different websites, whether it tracks its underlying benchmark true or not, or does it get out of kilter and end up being something that trades at a premium or a discount more often than not. Now, while that creates its own type of opportunities, if you're looking for momentum trading opportunities, or you want to get in and make a trade in pharmaceuticals or make a trade in some random sector, then just find the most liquid one, because that's all you want. You don't necessarily, if it costs 2 or 5 more basis points in terms of the annual management fee than another, it's not going to be as important as, is there borrow in it? Are there options listed on it? Are there, is there good daily volume that I can interact with? Those are the important things. But if it is a strategic hold or something for your retirement account or something like that, then definitely take the extra few minutes to find the cheaper one in terms of management fee and buy and hold that. I think a lot of the growth ETFs have had in the US is because a lot of them have options listed on them. And that's another cool thing. If you find an ETF you like or a theme that you like, and it has an ETF and it has listed options on it, even if you never do anything on the option side, the volume is going to be enhanced because of the options activity around it. Or in the event that you do want to get involved, then they're listed, they're an option, they're an alternative to actually trading the underlying security.
Can you just take a second to explain how those management fees work and when they actually take effect?
Sure. Most ETFs have, all ETFs have it listed and broadcast what their management fee is, an expense ratio, some call it. And that simply is the amount that BlackRock or Vanguard or State Street charges to run the product. That effectively drips out of the net asset value of the fund. So the price that you see on a screen during the day in the spider, that's a bid and offer. But every day, that basket of stocks that's behind that ETF is calculated and priced. And that's the net asset value for that fund. Now, the net asset value might be a little different than the last price spiders or whatever ETF traded. But from one day to the next, in a market that doesn't change, the price of the ETF will drop by that day's worth of the management fee. So we're talking about fractions of basis points on a daily basis of management fee drip out. So if you have a stock that doesn't move, if spiders goes from January 1st to December 31st and does not move, the ETF net asset value will be 9 basis points lower than it was at the beginning of the year, because that's how the fee gets calculated and basically charged by the manager. It's on a daily basis, and it just gets extracted from the net asset value of the actual fund. It's nothing that's too visible on a day-to-day basis because it's fractions of percent. So from a trading standpoint, it's not something that you're going to notice from one day to the next. As a holder, a long-term investor will want to consider to pay as little as they can, simply because they have been compressed so much. Now, some of the products that are more bespoke, and maybe they have currency overlays, or it's a unique strategy, an alternative strategy, they'll be more expensive. That's something that tracks a regular index, like the S&P 500 or a Dow. That's to be expected, that there's a little more special sauce that the manager is doing in order to manage it and put it together. But for the most part, the broad-based stuff is reasonably cheap.
Okay. And where can we find out how much those management fees are for each ETF? Can we just go to somewhere like ETF.com?
ETF.com is a very good resource for ETF information. I think they also have comparison kind of tables for similar products or products that track similar underliers, that they tell you what the management fee is. The issuers themselves, by regulation, have to publish what they are. They're going to be on any Bloomberg screen of this product description. But yeah, ETF.com is as good a resource for anything related to ETFs as anything else, just because it's so thorough. But yeah, that information is out there and public. The makeup of the baskets is out there as well. If you care about things like that.
Yeah, I mean, how much should we care about that sort of thing? Because, there are many ETFs, in most cases, there are many ETFs for each sector. Should we just be looking at the management fee, or is there sort of something else that we should be looking at? Like, should we be looking at the constituents of that ETF?
I think before the constituents, the tracking error, and a lot of websites, a lot of ETF information websites are starting to kind of follow that and post on that, because it matters in things that are, the S&P 500 is very easy to track. MSCI emerging markets, not quite. So there was a big thing a couple of years ago with Vanguard talking about their emerging market ETF versus, I think it was iShares emerging market ETF, and how the tracking error mattered and made a difference to the return of the investors in that. So for things that aren't supremely straightforward, somewhere in the realm of an S&P 500 or a S&P sector, the tracking error metric should be reasonably easy to find. Now, not necessarily be obvious. There's nothing you want to set up out calculating yourself. But then you want the lower tracking error. That tracking error will come from what the manager is using to track the index. And then if you want to get a little more sophisticated, then you want to see what they're actually holding, because in some cases they'll hold the perfect index, in others it's not feasible or convenient to do so they don't. And then you just want to follow the tracking error. And again, the lower the tracking error, the better your returns will be in terms of the benchmark.
Excellent. All right, let's leave it at that for now. Where can listeners go to find out more about you?
Well, I don't have too much of an online presence. I have a Twitter account that I talk about random things, so might not be that trading heavy, but so I'm sorry to disappoint there, I guess.
What is your Twitter handle? Give it out, because I'm sure someone will want to follow. Sure,
it's at EL_9UAPO. It's basically El Guapo. It's an old joke from the Three Amigos movie. Being the only Puerto Rican in a variety of trading floors and trading groups ends up inevitably with nicknames.
I can imagine. Well, I'll be sure to include a link to that in the show notes as well. Jorge, thank you very much for coming on the podcast, man. This has been really interesting. It's been great to hear your story, and I appreciate it.
No. Thanks for having me. It was a really good time. I really enjoyed the stuff that you've done, and I congratulate you on that. And you did scoop everybody on Ed Thorpe, so congratulations to you on that one.
Cool, man. Cool. Thank you very much for sharing. We'll talk soon.
Thank you, buddy.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.